Welcome back to Tesla Daily News Podcast. It's Thursday, December 20th, 2025. Today, we're tracking a mix of real business momentum in Tesla energy, some very real optics and regulatory risk around full self-driving, and a clear reminder that Europe is getting tougher for Tesla just as Chinese competitors accelerate. Let's get into the 5 biggest Tesla stories that matter for investors. Story 1. Tesla Energy lands another utility-scale win in the UK, 1 gigawatt-hour of Megapacks. Tesla just signed a full EPC agreement for a 500 megawatt, 1 gigawatt-hour battery energy storage project in Scotland with Matrix Renewables. Here's the context investors care about. Tesla's vehicle business is still the headline driver for revenue, but the market increasingly values Tesla like a platform company. Energy is one of the cleanest ways Tesla can show profitable growth that's less sensitive to EV demand cycles and pricing pressure. The key details. This is a 1 gigawatt-hour build, which is big. A project at this scale typically means meaningful Megapack volume and multi-quarter revenue recognition. It also supports the narrative that grid-scale storage demand is structural, not trendy. Impact for the stock. Large Megapack awards are a sentiment catalyst because they reinforce 2 valuation points. 1. Tesla has a second major engine beyond cars, and 2. Tesla's manufacturing scale in batteries and power electronics translates into real contracts. Investors will watch margins here, but the biggest near-term effect is narrative support for diversification. Takeaway. If you're modeling Tesla purely as an automaker, you're probably missing upside optionality. Deals like a 1 gigawatt-hour Scotland build are the type of evidence that makes energy growth a real line item, not a slide deck promise. Story 2. Full self-driving risk is back in the spotlight after a livestream crash. A video-covered incident involved a Tesla driving the wrong direction and colliding head-on while full self-driving features were being demonstrated during a live stream. Context. For Tesla's valuation, autonomy isn't just a feature, it's the biggest multiple expander in the entire story. But autonomy is also where regulatory scrutiny and reputation risk can hit the fastest. Details. The report describes wrong-way travel leading to a head-on collision. Even without full adjudication of causes, these incidents tend to travel faster than corrections do, especially when video is involved. Impact on Tesla. Autonomy headlines can affect near-term sentiment, and they matter for longer-term probability weighting of robotaxi economics. If regulators or insurers conclude usage patterns are unsafe, or if consumer confidence drops, Tesla can face slower FSD adoption, higher friction in approvals, or tougher oversight. That feeds directly into how investors discount Tesla's autonomy revenue assumptions. Takeaway. Bulls should still anchor on measurable signals, disengagement rates, safety metrics, and regulatory approvals, but investors should also respect that one viral clip can shift the short-term narrative and raise the perceived tail risk. Story 3. A second dataset challenge to the robotaxi narrative, smaller than claimed, and frequently offline. Another report based on independent analysis suggests Tesla's robotaxi service footprint is far smaller in practice than headline numbers imply. The claim is that while there may be around 32 vehicles listed in the service, only about 5 can operate simultaneously, and the service was reportedly unavailable 60% of the time last week. Context. Robotaxi is the core of the autonomy bull case. The market pays for scalable autonomy when it sees reliability and utilization, not just a fleet count. Details. The meaningful numbers here are about 5 operating concurrently and 60% downtime. Whether the exact figures hold up or not, the discussion highlights 2 key investor questions. How often can the system actually run, and what is real capacity utilization? Impact. If reliability is low, the market will likely discount near-term robotaxi revenue and push out timelines. Timelines matter. A 1-year slip in autonomy can change discounted cash flow outcomes materially because the valuation is so sensitive to when high-margin software revenue arrives. Takeaway. Don't just track how many vehicles are in the program. Track uptime, operational hours, and whether the service is expanding geographically in a measurable way. Story 4. Tesla registrations in the European Union reportedly fell more than 34% in November. A Clean Technica report cites a 34.2% drop in Tesla registrations in November in the European Union. Context. Europe has been one of Tesla's key international demand pools, but it's also where competition is intensifying fastest, especially from Chinese brands and from European incumbents getting serious on cost-optimized EVs. Details. The number to remember is down 34.2% year-over-year for registrations in November, according to that report. Impact on the business and the stock. If that trend persists, it pressures volume growth and can force more pricing action, and pricing action tends to squeeze automotive gross margin. It also shifts investor focus toward the question Tesla has faced all year. Is growth coming primarily from new products and autonomy, or does the core vehicle lineup need a stronger refresh cycle and better regional fit? Takeaway: watch Europe like a stress test. If Tesla can stabilize share in Europe without heavy price cuts, that's a meaningful signal about brand resilience and cost leadership. Story 5. BYD's export surge underscores how fast the competitive map is changing. A separate report says BYD is approaching a milestone of exporting 1 million vehicles in 2025. It also notes that in November, BYD exported 128,067 passenger vehicles, reportedly up more than 300% year-over-year. Context: for Tesla investors, BYD is not just another EV maker. It's the clearest example of scale, vertical integration, and aggressive international expansion. Details: the big numbers are approximately 878,000 exports year-to-date in 2025 and 128,000 exports in November. Impact: BYD's ability to push volume into international markets can increase pricing pressure, especially in regions where consumers are more price-sensitive and where subsidies, tariffs, or local production rules can change demand quickly. Even if Tesla keeps its premium positioning, the presence of capable, cheaper EVs can compress the overall industry margin pool. Takeaway: Tesla's defense is not only cost reduction, it's also differentiation through software, charging experience, brand, and product cadence. The more BYD proves it can export at scale, the more investors will demand proof that Tesla's differentiation is monetizable. Story 6. Tesla and Samsung foundry chatter, the 2-nanometer race and what it could mean. Multiple reports suggest Tesla is among customers discussing 2-nanometer chip manufacturing with Samsung, with a push toward 2026 targets, including staffing and equipment upgrades tied to a Texas facility. Context: compute is a bottleneck for autonomy and AI. If Tesla can secure leading-edge semiconductor capacity at the right cost, it can support faster iteration on inference hardware and training infrastructure. Details: the key timeline mentioned is 2026 for scale-up, and the key node is 2-nanometer. Even if exact volumes and product plans aren't public, the market reads this as Tesla trying to ensure supply and performance for AI workloads. Impact: strategically positive, but investors should keep it grounded. Semiconductor node leadership does not automatically translate into FSD profitability. Software performance, safety validation, and regulatory approval still dominate. However, reliable access to advanced chips can reduce execution risk and improve competitiveness versus other autonomy stacks. Takeaway: treat chip supply as an enabler, not the product. It improves Tesla's odds, but it doesn't replace the hard work of making autonomy safe and commercially viable. Before we wrap, a quick market note. Tesla shares were reported down about 0.65% in the most recent session cited in the coverage, closing around $485.56 with heavy trading volume. Some of that attention was tied to ARK Invest trimming Tesla again, a reminder that even bullish long-term holders actively rebalance. Let's close with the big themes for Tesla investors today. 1. Tesla Energy continues to stack real, large-scale contracts. The 1 gigawatt-hour Megapack project in the UK is exactly the kind of proof point that can support a higher-quality growth narrative. 2. Autonomy remains the swing factor, but also the biggest headline risk. Crashes and robotaxi reliability claims can move sentiment quickly and influence how investors discount the robotaxi timeline. 3. Europe is a competitive battleground, and the combination of weaker Tesla registrations and BYD's export surge highlights the need for Tesla to defend share without sacrificing margins. What to watch tomorrow? Any fresh updates on end-of-quarter delivery expectations, additional Megapack backlog announcements, and whether regulators or Tesla issue clarifying information around the latest FSD incident coverage. Thanks for listening to Tesla Daily News Podcast. If you want this show in your feed every morning, subscribe and follow us for daily updates on the Tesla stories that actually move the stock.